Good afternoon, everyone. I'm Giles Swan at ICI Global. For those of you that don't know us, ICI, the Investment Company Institute, we are not the failed chemical and paint company, Imperial Chemical Industries. We are the Investment Company Institute, and we're a trade association. We have investment funds as our members, and investment funds that are publicly available. We have a global membership, so in this part of the world we're talking about UCITS funds, but 1940 Act registered investment companies in the US, investment trusts in Japan, etc. So, thank you to QED for inviting someone from the buy side. I will try and provide you with a buy side perspective on recovery and resolution from the point of view of an investment fund as a customer, a client of a CCP member. Now, I'm going to use the analogy of a car, and I'm going to do this for three reasons. Firstly, because Henrik started us off referring to analogies with nuclear power stations, and every other speaker has done so, so I feel the need to adopt the same. Second reason for using a car as an analogy, I'm a very simple person. I'm new to this area, I'm not an expert, I haven't dealt with the Lehman default. I'm not an expert in financial market infrastructure, so I need to understand this in simple terms. And the third reason why I'm going to use a car is that I am the seventh person that you have had to listen to this afternoon standing up here, and it's nearly 5 o'clock. So I need to make this as interesting as possible, or you're all going to be looking at your mobile phones within minutes. And you know, I don't criticise you for doing that either. So let's talk a little bit about where investment funds, where the buy side comes from in terms of recovery and resolution, the outcome we're seeking to get to when we get into the car. You can see the analogy starting to build here. And then where's the journey we want to go on with the car? Where do we want to get to? So we support the development of really some consistent standards and rules around the world. You know, we don't care if the car's made slightly differently in the US to Europe or Asia. But, you know, we need at least consistency. There's a lot of talk about harmonisation. You know, we don't all drive on the same side of the road. You know, I think that's a bit ambitious. But we want some coordination, don't we? You know, we want the ability to use a car produced in one part of the world where they drive on one side. You sort of want the ability to be using that in a part of the world where they drive on the other side. So, you know, not everything the same, but coordination, consistency. So we've engaged with the Financial Stability Board. They've done a lot of work in this area clearly, and most recently around recovery and resolution and the way in which equity is used in resolution. And then clearly European level, we support some consistency, commonality in rules. You know, we support an outcome really which incentivizes clearing, or at least doesn't disincentivize clearing. Yeah, hopefully that's fairly common sense. You know, where do we want to get to? So I think we want to get to a place where the CCP recovery and resolution rules support confidence in capital markets and protect the end investor. You know, investors, European citizens are using investment funds, they're giving their money to fund managers to manage as agents or as fiduciaries, and they're using CCPs to help citizens achieve whatever they want to achieve, growing their capital, income in retirement and the like. So to some extent funds are mandated to use derivatives, they're mandated to clear, and they're clearing at cost. So coming back to our car analogy, you know, we are paying CCPs fees so they can buy the petrol or diesel, or, you know, we're in an ESG sustainable finance agenda at the moment, so they buy the batteries and charge the car up, maybe. That's a better way of doing it. But the car, the motor, needs oil, and that's margin. That's what clients of CCP members are providing, the oil. They top the oil up initially, and then through variation margin, they appreciate that the motor burns a bit of oil over time, so they've got to top that up. But we're relying on the CCP following the rules. You know, we don't want the police or the resolution authority turning up because something's gone wrong. And funds as clients of CCP members, they're clearing at costs, but they are not participating in profit. So when the CCP sells that car and gets another one and makes some money, there's no benefit to the fund as a client of the CCP member from that. We're using the service, if you like, and paying a fee for that service. So we want outcomes where there is a good degree of balance between regulatory flexibility and certainty, and I'll come on to that in a moment. Market confidence, resiliency, I think that's a word, but so the CCP is resilient, you know where I'm going with that. And then transparency and disclosure. So let's talk a little bit about those outcomes. So balance between flexibility and certainty. So this is critical, but there are competing objectives here in the time of crisis. There needs to be flexibility in the way that CCPs use tools, but some constraints around that, but also some certainty as to how, if something goes wrong, the car is driven too fast, the mechanic can't fix the problem, the car has to be scrapped, maybe we'll call that resolution, the way in which a resolution authority can step in and deal with that, and there needs to be transparency around that. Also, recovery and resolution needs to be clearly defined. There are aspects of that in the European debate at the moment, but I think we see a need to very clearly define resolution and recovery at global level, or at least have some consistency. Recovery where the CCP is drawing on resources that it or its members have allocated for recovery, and then resolution is the point where those resources are used up. A particularly important issue for the buy side and for funds is that resolution strategy should not be relying on resources of those individuals that are not responsible for the risk management of the CCP, and that's funds, that's clients. So resolution strategy should rely on the resources of the CCP itself, shareholders, and of its members, and that non-defaulting customer assets should not be relied upon in resolution strategies, because funds are exposed to the losses from risk management. They're exposed to the car being driven recklessly, poor driving decisions, but they don't profit from that, and clients of the CCP members are not behind the wheel of the car. They're sitting in the passenger seat. And so there shouldn't be recourse to client assets as part of resolution strategies. So there needs to be certainty, as I mentioned, to provide around the tools for recovery and that are available to the CCP, and the way in which the resolution authority is going to resolve a CCP. There has been a discussion at European level about the tools that are available to CCPs, but I think we feel that less so around the use of resolution strategies. Coming on to margin haircutting, which I'm sure we will discuss, we do not feel that that is an appropriate measure, variation margin gains haircutting, or initial margin haircutting, or contract tear-ups, because we see that as effectively supporting the failure of a for-profit enterprise and keeping that enterprise in business. Moral hazard, and we feel that not using customer assets in that way actually strengthens financial markets, because there's a range of other tools available, CCP to take the losses, pre-funding and the like, which doesn't cause moral hazard and supports market confidence. So, hopefully that's provided some background to where the buy side is coming from here, some of the outcomes we want to see, so a balance of flexibility and certainty, resilience, and then transparency, particularly around the toolbox for CCPs and around the way in which resolution authorities will resolve the CCP. I've tried to make that as interesting as possible. Thank you for listening.